Hello traders, and welcome to this video where we are going to be taking a look at risk management. This is part one of what will be a 3 or 4 part series looking into this subject, and in this video we are going to be starting off with an introduction and looking at position size and how to calculate your position size. In further videos we're going to be looking at invalidations, we're going to be looking at take profits, entries, and all those other nice things that go along this subject. The aim of the series is just to keep these videos fairly short, 20 to 30 minutes long, in order to cover this subject as kind of precisely as possible, instead of having to trawl through hours of content on what is really quite a boring subject that's overlooked by so many people. But it is such an important part of trading, and you've got to understand risk management if you even stand any chance of being profitable in this game. So first of all, little disclaimer, okay, as always, this is not financial advice. None of my videos ever are financial advice. I am not a financial advisor. I do not want to be a financial advisor. I am just some guy talking nonsense on the internet and sharing my thoughts on things that may be entertaining or educational in some weird way. That's that disclaimer out of the way, okay? So let's get straight into the actual content then. So without risk management, you will lose your account. You can have a profitable strategy, but without risk management, you only need one bad trade to be liquidated. And we see this all the time, and I'm sure this is resonating with a lot of people who are watching this. You see it all the time, right? People can think that they've got good strategies, their trading can be going really well, but it only takes one trade to blow up an account. For example, if you're really confident trading on like a 5-minute time frame or something like that, and we've got low volatility kind of price action going on, it's all well and good. Like, whilst that volatility is low and whilst price is fairly stable, but what happens, and it always will happen at some point, when you get those 10% moves that just come out of nowhere, if you're caught on the wrong side of that, account gone, or a significant proportion of that account will be gone. And that's what I mean, okay? You've got to have your risk management in place so you're not caught up in those big moves that are maybe unexpected, or maybe you're on the wrong side of. So yeah, I'm sure probably a few people watching this, probably the majority of people watching this, have been through that situation. I know I certainly have when I first started trading, and that's, yeah, I guess why we're doing this video. So next point here, trading rewards longevity. Okay, you are learning a craft. As with anything, it takes time to master. You set your own price for learning. Stay in the game. This is not a get rich quick scheme. So if you have come into trading thinking you're just going to be able to quit your job, thinking you're going to be able to change your life within a few weeks and make a load of money, stop thinking like that. That is not the case. That is not realistic. 1 in maybe a million traders might take 100x gamble on something and might win, but that is gambling. That is not trading. If you want to stay in this game and have longevity in this game, you need to have risk management down, and you need to be sensible about it. You need to have time to learn your craft. Okay, the other thing here, you set your own price for learning, and this is very important because everyone's risk management is different and it is personal to them. Your own risk management, you are the only person that can decide on your own risk management, okay? Your account balance, your risk appetite is going to be substantially different, probably, to my account balance and my risk appetite. So you've got to decide this yourself. You set your own price. And the other thing is, because you set your own price, you've got to make sure you are sticking to your price. If, for example, you're going and you're paying for, I don't know, a swimming lesson or something like that, and you're paying $30 an hour and you've got a budget for 10 lessons, you're not going to go there on the first lesson and just give your instructor $300 at the end of that and say, okay, oh no, I can't go to any more lessons because I've just paid you $300. It just wouldn't happen in real life. So why would you do that in trading? Why would you have an account and just throw it all into one trade? Yeah, you've got to have that longevity there. You've got to be able to maintain that account balance and that account size to even have a chance of learning something before you can even think of becoming profitable. So that's the second little point here. Third point, okay, this is your job now. Stay within your pay grade. And even if you are just doing trading as a hobby, you have got to view it as a job. Otherwise, you will never become profitable. Even if it's just a part-time job and you're just doing this for a few hours a week, think of it as that. Because if you're doing it as just for fun and you're just like, oh, I'll just throw some money at this, it's not going to work. Unless you're really lucky, it's like going to be a lottery win or something. It's not going to work long term. Won't happen. Okay, so start low, scale slowly. Okay, you want to be having a position size that is manageable for you. A larger position size equals more emotion. You do not know how you will react. So if you are used to making, say, $100 a day, you're not going to be able to trade with $1,000 a day. It's just going to be too much for your brain to handle. You need to set yourself an amount that you are used to managing in your day-to-day life. If $100 feels like a lot to you, make sure you're risking less than that, okay? So that it doesn't matter if you lose that money. It won't bother you. Trading should be fun. Trading should be enjoyable. It should not be stressful. And if you're putting too much on the table, you're going to get stressed out about that and you're going to make bad decisions. Which leads me on to the next point here. If you find yourself worried about a trade or hoping the market does something, then you are risking too much. Kind of just explained that, right? As a new trader, your focus should be on taking good trades, not making money. If you make good trades, the money will come. Again, very important. And something that's often overlooked, like so many people coming into this market, they're just like chasing the market all over the place, not really doing their analysis, not really properly researching what it is or properly making a plan. They might get lucky 4 times and then one trade comes in and wipes out their account. And that's what I mean. You've got to be focusing on making good trades. If you are making good trades, the market will reward you for that. The market's pretty efficient, okay? It works. Technical analysis works, believe it or not. And if you know what you're doing, you're going to make money in this game. But it does have to all start with risk management, because every trader makes losses. You can't make good trades every single time, but you've got to have a focus on trying to make those good trades. And then if you can start to get some consistency with that, the money will come. Okay, so that kind of gets out the introduction. So let's move on to the main subject matter of this, which is position size. So we are going to start here with the 1% rule. Now, you may hear the 1% rule, you may hear the 2% rule. It's entirely up to you. I'm going to use the 1% rule on this video because I do think that this is probably best if you are like beginner trader, or if you've been liquidated on accounts before. Get yourself back to 1% and just learn, right? Because that's how you're going to become profitable eventually, is actually winning trades, because you're probably more used to losing right now than you are winning. So we got to get you winning. And this is why 1% is important. You can start to increase it at a later stage, but 1%, if you're maybe a bit more experienced, 2%, anything more than that, kind of risky, at least for me anyway. So we're going to take a look at this calculation as the 1% rule. And a little bit of a kind of intro to this. If you aren't kind of employing good risk management on your trading, and you take a trade and you lose 50% of your account, you're going to need a 100% gain just to break even. And this is something, again, that a lot of people forget, right? If you throw all your money into one trade and you're doing it on leverage and you see price come down and suddenly your $1,000 account has gone to $500, you've lost $500, right? You've got to be able to process that. A lot of people can't. And you've then got to make 100% back, double what you just lost in a percentage terms, just to get back to where you started. And that is such a difficult thing to do. It happens, it's doable, but very, very rarely would you see anyone who is down 50% on their account get back to even break even. Because what happens at that point, you've gone in, you're thinking, okay, cool, I'm gonna go in with $1,000, that's a good amount, I can start to make some money. Suddenly that account's 500. What are you gonna do? You're gonna risk more. So you've already risked too much, and now you're gonna get into that habit of risking even more, because you're like, oh, this isn't enough. I need to get back to 1,000 so I can start properly. So you're going to end up throwing your whole account at something. And I'd say if it's taken you maybe a month to lose 50% of your account, that last 50% will probably be gone in 2 days, because you'll find yourself over trading, you'll find yourself chasing the markets, you'll find yourself revenge trading and risking way too much of that account in order to even get back to break even. So again, slippery slope, all right? If you're kind of employing these tactics, risk management, right? This is why we're here. However, if you risk only 1%, you can take 10 losses in a row and then only need an 11% gain to reach break even. So, and 10 losses in a row is very unlikely to happen either. You'd have to be doing something pretty seriously wrong with your technical analysis, and then it's kind of back to the drawing board, right, entirely, with your TA and your trading style. But your account would be able to absorb 10 losses in a row if it really had to, and you're not really going to be at that much of a deficit to where you were before. You've only got to make back 11%, very much doable. Your $1,000 account may now be at $900. It's not a big difference, really. You're not going to really notice that much of a difference within your trading. You're not going to feel like you've got to chase the market by doing this. So it just it enables you to continue going and to find a strategy that works, so that you maybe aren't making 10 losses in a row. Maybe you're making 5 wins and 2 losses, and then 3 wins and a loss, and 2 wins and 3 losses. And you can kind of go on like that and start to build some consistency and get that account back to where it should be. Because really your job as a trader is to stay in the game long enough so that you can find like really cool stuff that gives you an edge on the market that you can make some money from. And that's going to take time to develop, because again, it's very much personal to you. There are tools out there, and of course there's certain strategies that I've developed over time that work really well for me, but they might not work for you. So that is your goal, is to find that stuff that gives you an edge. You can trade profitably, but you've got to be in the game long enough to find that for yourself. Risk is not defined by position size. It is defined by your maximum loss. So again, this is something that a lot of people misinterpret. So 1% does not mean 1% of your account. So you're not simply going, okay, I've got a 10 grand account, I'm just going to put $100 on every trade. No, it means that is the maximum you can lose if you are stopped out of that trade. So you might be trading with $500, but as long as you're only losing $100 on that 10 grand account, you're still only losing 1%. So that is the risk associated. That's your risk, is the 1%, not your whole account balance or your whole position size. So in order to calculate your risk, and now we're getting into the main part of this video, in order to calculate your risk, you need to know your account size. And then basically, if we're looking at 1%, which we are in this instance, obviously if it's 2%, you change this number. But we're looking at your account size, and you times that by 0.01, 1%, and that gives you your 1% risk, or obviously 0.02, and that gives you your 2% risk. So for example, if you have a $10,000 account and you times that by 0.01, that is $100. That is how much you want to risk on each trade. If you have a 1 Bitcoin account and you times that by 0.01, it's going to be 0.01 Bitcoin. So that is how much you want to risk on one trade. Okay, hopefully that makes sense. It's pretty straightforward. No rocket science here, but this is where it starts to get a little bit more complex. So, to calculate your position size, once you know your risk, you must know first of all, you must know your risk, but you must also know your invalidation on a trade. Okay, and we are going to be going over that in the next video. But you must know your invalidation first of all. So your position size is equal to your account size times by your account risk divided by your invalidation percentage. So that is the percentage between your entry and your stop loss. Okay, so we're going to go through this calculation. Hopefully I can explain it clearly enough. I'll give you an example in just a minute. So here is our example, and we're looking at Bitcoin here. Okay, so let's say you want to enter this trade at $46,000. Your invalidation is at $40,000, and your target, irrelevant for this, but it's at $60,000. Your target doesn't matter. Okay, what is really important here is your entry and your invalidation. You cannot enter a trade unless you know your invalidation. So many people get that wrong, but that's a very important part. So you must know your invalidation. So to calculate this, you need to know these things. You need to know your account size, your account risk, your trade invalidation, and then the percentage between your entry and your invalidation. And you divide that, your risk, by that number. So let's take a look at this. Let's take, for example, our $10,000 account that we were looking at just a minute ago. Your account risk on this is 1%, that's $100. Your trade invalidation is your entry being at $46,000. Your stop loss, your invalidation, being at $40,000. So then you calculate the difference between the percentage between your entry and your invalidation, which is this following calculation. So in order to get this, stay with me, there is an easy way to calculate this. But you will be first of all looking at where your stop loss is. So that is your stop loss, which in this case, $40,000, minus your entry, $46,000. Then you divide that by your entry. So this would be minus $6,000, right? Divided by $46,000 and then times by 10, which gives you 13%, or thereabouts, like 13.084 or something like that. Okay, so that will be the percentage between here and here, and that's the calculation. Okay, then you divide your risk by that number. So 100 being your risk, then you divide it by 13%, 0.13, and then this gives you your position size. Okay, and this will be $769 on this trade, so that if you are stopped out of this, you know you're going to lose $100. So the other way that you can calculate this, very simply, okay, TradingView. So I'm sure a lot of you know TradingView. Here is the trade that we were talking about, and if you go onto your left hand side here and you get your position tool and you place this around, where was it, $46,000, close enough. Okay, you place this here, 46,000. Your invalidation was, what was it, 40,000. So you can see here down at the bottom, this gives you your percentage. Target, irrelevant, doesn't matter in this calculation. It can be up here, it can be down here, it can be here, whatever you want. Okay, but your invalidation, the difference between the two is this number that it shows you here. So 12.98%, obviously I've not done this exact, but you can see how this number changes at the bottom. Hopefully that is clear enough for everyone to see. There we go. Okay, make it a bit bigger. So there you go, you can see the number right here changing. So that is how you calculate it. Of course, if you want to take a short position from up here, you wanted to take a stop loss above these highs, you wanted to take a short from $66,000, stop loss above the highs, and you're aiming back down towards 50, whatever that is, down here. You know that you've got a risk or a percentage difference of 5.37%. So then you would go back onto this, you would do that same calculation, you would have your stop loss, take away the entry, divide it by your entry times 100, and then you get your percentage from that. But again, you can do it just on TradingView, or if you don't have TradingView and you're using something which maybe doesn't have these, then you can just Google position size calculators. They're everywhere on the internet, so it's relatively straightforward to do that. So hopefully that did make sense. Okay, so that's that. And now we're going to go into the final part of this video and just go over some kind of key points and some extra notes on this. So position size can be calculated on TradingView using the long position or short position tool, or by using an online trade size calculator. Just explain that. Exchanges will often show your position size in the opposite value to the instrument you are trading. USDT contracts shown as asset value, inverse contracts shown as in USD value. Be aware of this and know the calculation for the pair you are trading. So this is where you can sometimes get stuck, okay? Because in order to know your risk and the position size that you're going to need to take, often, and for example, if you're taking a trade on the USDT ETH, the ETH USDT pair on Bybit, for example, it's going to show you your position size in Ethereum. Now, if you're trading the USDT pair, your account is likely to be in USDT. So you want to be calculating that in US dollars. However, it's going to show you when you're entering your account as your Ethereum value. So you do have to be aware of that. It's something that's really annoying from the exchanges, and probably there to confuse you. They'll argue it's within the mechanics of it and everything, but in essence, it's just confusing. So just be aware, okay? And then again, the inverse to that is if you're trading, for example, the Bitcoin Invest Perpetual. So you have your account in Bitcoin and you know how much Bitcoin you want to risk. When you go and trade the Invest Perpetual contract, it's going to show you that value in US dollars. So be aware, make sure you are calculating for the exchange as well as just your own risk from this, okay? A little bit complicated, but you get used to it eventually, I promise. Your stop loss is there for a reason, okay? Stick to it. Use a soft stop only when you are consistent and reduce position size by 10% to allow for slippage. So this is very important, okay? If you've got a stop loss, it's there for a reason. You've planned this trade. If you get invalidated on that trade and you've lost that $100 from that 1% of the $10,000 account or whatever it is, cut it. Yeah, you can always, that account is okay. You've only lost 1%. Cut the trade. You can only always get that back. And that's the point. You're looking for risk to rewards of like 3 to 1, 4 to 1, anything like that. You can make that money back. What you do not want to do is leave a trade running that's hit your invalidation and start hoping that the market recovers and turns back in the direction that you wanted it to go to initially, because then that becomes a gamble. Okay, that's not trading. So there is the concept called a soft stop loss, and this is something that I do use myself quite often, but I would recommend you only start using that when you're consistent and you want to reduce your position size by something like 10% in order to allow for that slippage. So let's say, for example, going back onto this trade, okay, can we just bring that back up here, roughly? So let's say, here's the trade, okay, it's going well so far. You maybe hit take profit one, then price comes down here. What I might do at this point is price is like hovering around this area. I probably wouldn't want to just hit my stop loss immediately at 40k. You give this a bit of time, and this is at this point where what I mean by soft stop loss, you're not just getting stopped out just in case the market does this. But if it doesn't do that, and you start to find the market's moving down, at that point you want to get invalidated, but your actual exit may be like 39,500 rather than 40k. You may lose a bit more. So I just say, if you are losing a soft stop loss, reduce your position size slightly just to allow for that slippage if it is to invalidate you a bit lower than where you initially had planned your invalidation. Okay, because you do have to give the market chance to do stuff like this, because it happens so often. Stops get hunted, but again, something that you need to be fairly experienced in order to start doing, and you need to know when you're invalidated. Okay, you need to know the order flow and all of that kind of stuff. So that's that example. Okay, back onto here. Okay, this next point, it may seem complicated at first, but after a few trades it will become second nature, and I promise that is the case. Okay, this may sound kind of confusing with all these weird calculations and stuff and having to put in these weird position sizes, but trust me, you get used to it. Within a few weeks you'll be used to it. You'll just know what your position size is. You'll know if your account's growing, if your account's reducing, and you'll know how to manage that. It just becomes second nature. It becomes very, very straightforward. You don't even have to think about the calculations. Give yourself a couple of weeks, put in the work now, and then you just don't have to think about it again. But it's what so many people do. They never even think about it in the first place, and then they get wrecked and they're no longer trading. So yeah, that's kind of the point with this one. So to manage time more effectively, you may wish to maintain position sizes for a set amount of time and review them periodically. So for example, if you start with $10,000, maintain that for a week and then adjust depending on your balance at the end of the week. So by this, I mean, no one's going to want to be calculating their position size every single trade. But if you know you've got a 10 grand account and you know you're only risking 1% per trade, and you know you've taken 20 trades where 14 have won and 6 have lost, you know you're going to be roughly like in pretty good profit there, and you're still going to be around maybe that 10k mark. So just review it periodically. Maybe you want to look at it once a week, every Monday or something. Maybe you come in the following Monday after you start your 10 grand account. Maybe it's up to 10,400, and then you can decide what to do. Do you change your position size, increase it by that extra 0.4% or whatever, to start to compound on that? Or maybe it's down by $1,100 or something, and then you want to just kind of reduce your position size slightly to account for that slightly lower start point that you're at. But you don't need to do it on every trade. It's something that you can just review periodically. Alternatively, and this is what I do quite often, especially with my day trading account on Bitcoin, is to maintain the same size account and then bank the profits at the end of each week. So like I say, this is a job for you now, right? And if you're working, you're going to be wanting to pay yourself. So either you can look into the compounding your gains type of strategy, all well and good. But if you're looking at this as just you want to make consistent money on a regular basis, a really good thing to do, and this actually makes it a lot easier because then you can just keep the same position size forever, basically, until you feel like comfortable enough to change that. Just bank your profits each week. Or if you're making a loss, then kind of manage your account, maybe reduce your position size slightly to account for that. So let's say you've made $200 in a week on your 10 grand account, bank that, put it back to 10 grand, start again the following week. Relatively straightforward, okay? So that's another strategy you can employ. So again, next point here, increase your risk only when you achieve consistency above a 50% win rate. And I'd say ideally more, but I think a 50% win rate is pretty good for any new traders. If you're able to achieve consistently a 50% win rate, you should be profitable overall because your winners should be bigger than your losers if you're employing good risk management. Okay, so once you have consistently above that base level of 50%, once your win rate's there, you can start to increase your position size if you wish to do so. However, you should increase slowly in order to keep check of your emotion and your impulse. If you start to fear your losses, then ease off on the risk. Very important, okay? You're not going to want to go from $100 risk on a trade to $600 or $1,000 risk on a trade, because suddenly you're going to be like, oh boy, this is like too much. And if a trade goes against you, even by a normal amount, you're going to get worried by that. You're going to get frightened by that. And you'll either find yourself closing out of your position too early, not allowing the market to do its thing. Maybe you go underwater slightly. If you're risking 100, fine, doesn't matter. Okay, I'm only going to risk 100. But if you increase that too quickly and it becomes an amount that your brain can't like handle losing, then you're either going to close it too quickly, and then the market's just going to go the way you wanted it to, and you're going to become very frustrated very quickly. Or you're going to see that number go down, and you're going to be like, oh man, I can't lose this. I can't lose this. I can't lose this. So then you hold your trade for too long. You start making bad decisions within that trade. You start hoping the market's going to turn back in your favor. And then what happens? You've forgotten about risk management and you get liquidated. And this just happens all the time, right? So if you start to fear your losses, ease off on that risk. I'd say an increase of 5 to 10% each month is pretty reasonable. So if you've had a good trading month, you're happy, you're above that 50% win rate, you're profitable, everything's going okay. If your risk has been $100 and that goes up to $110 the next month, you're able to compound that, but it's not going to really affect your psychology. Losing $110 isn't much different to losing $100, so you can start to cope with that, and you can just scale yourself slowly, and you'll find eventually that $110 turns into $120, turns maybe into $150, turns into $200, turns into $250, turns into $500, and so on. And that's how you scale an account. Okay, so very important there. You've got to be able to trade what your kind of brain is happy to lose a lot of the time. And yes, I know you're not going to have the big gains that you want to have if you're taking big risk, but the time will come for big gains if you do build an account sensibly. And by this time next year, if you're doing good risk management, you're taking good trades with a consistent win rate, you're going to be significantly higher position sizes than you could even think about doing right now, and you'll be making good money. And that's the thing, it doesn't take that long. You've just got to be patient, and you've got to keep on building that account. Start slow, and then eventually it just starts to take off, and it's a great thing. A parabolic equity curve is a wonderful thing, trust me. So yeah, I think that wraps up this video. Thank you very much for watching. I hope that was helpful. In the next video, we are going to be looking at our entries and our invalidations. Okay, so the next very important part of this, but let's get that risk management down. Let's get the position sizes down, because I know a lot of you can already trade. It's just about getting this this kind of risk management in place, your position sizes, and then we'll take it from there in part 2 of this video. So thank you very much for watching. I hope you have a great week, weekend, whatever time of day it is you're watching this, and I'll catch you in the next video. Cheers, bye.